This is horrifying. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the American way of life nears its final chapter as China does the unthinkable. And governments around the world are now facing their biggest crisis since the pandemic, while the U.S. banking system, which we know is near insolvent, is now facing its worst case scenario. And if you're wondering what we're doing at this construction site today, well, it has everything to do with the impending collapse of the commercial real estate market. Let's over to Bloomberg, where we picked today's story up with a headline: UK's long-term borrowing costs surged to the highest since 1998. And this is going to be a big issue for governments around the world, because we're now seeing long-term interest rates back up to their highest levels since the global financial crisis. And this is an issue because we know during the pandemic, governments took on trillions. And in the case of the U.S. government, $10 trillion of new debt. Well, it has to be financed somehow. Leaving us the question is, are they going to issue more long-term debt, or in the hopes that rates come down, start issuing more short-term debt? Because as taxpayers, we know there's only one ultimate response to this, since governments almost never usually cut their spending, and we know they need to. That means they're going to have to raise taxes as the world heads into a recession. The yield on 30-year gilts climbed as much as 9 basis points to 5.6%, surpassing a previous peak just seen over a year ago that was initially sparked by former Prime Minister Liz Truss's tax giveaway plans. And things like this by investors aren't going to be well received, because they know if you're going to give away more money, that means you're going to have to issue more debt. It only becomes a question of how high rates have to go before investors are happy getting and giving the government more money. And while the rise this time has been more gradual, investors are demanding greater compensation to lend the government money, given an uncertain economic outlook. And of course, we know what happens during certain periods of uncertain economic outlook, and we're going to make the case, given what's going on in the U.S. commercial banking system, why rates ultimately come down no matter what price they're at, because it doesn't matter if investors want to buy them or not. It's everything to do with how the global monetary system works. But right now, the broad belief is rates have to go higher as governments seem to be unable to rein in their spending. The latest leg higher in UK yields follows similar moves in U.S. rates, as the U.S. 30-year has risen around 15 basis points in the last two sessions to the highest level since 2007, again, where we know that sparked the global financial crisis. The spike this time is different to the circumstances seen last year, when the bond rout was idiosyncratic to the UK rather than part of the global sell-off. And while the recent rise has been more orderly, it still reflects a challenge for UK policymakers and investors. And real issue here, if we start to look at the U.S. and why rates have backed up, has everything to do with what Fed Chair Powell said, and we'll come to that here in a second. Because when we look at this chart here, what we finally see is the Fed has gotten rates back up, at least on the long term, to match where they thought they needed to be. We noticed the federal funds rate continued to rise as long-term yields started to fall. Now, one thing that's important to understand here is long-term interest rates have everything to do with growth and inflation expectations. So this means investors around the world are either buying into the growth story, the inflation story, or perhaps both. But the real story here has nothing to do with that, because I'm going to show you why growth and inflation are indeed coming down. We continue to make that case on the show, but the real reason long-term rates are backing up is because Fed Chair Powell said if they keep going up, it might mean he stops cutting rates. And for an equity investor, that's about as much music to your ears as you can ask for. And that's why we're seeing investors and speculators aggressively shorting the long end of the curve to give the Fed what they want, so they can in turn get what they want as well, which is higher stock prices. As Fed's Metre says, interest rates are at or near a holding point, and no surprise, it's because rates went up too quickly that all of a sudden central bankers are panicking here. They're getting nervous. They do not like rapid rises in rates. If you ever wondered why we get these 0.25% hikes, maybe occasionally 0.5% over extended periods of time, it's because they want the financial system to adjust for this. So when you see a rapid move in rates, particularly to the upside from a central banker's perspective, that means you better pause and better better pause quickly and let the financial system digest it, because if it can't, that means you just push the economy into recession. And as a central banker, you never want to be on the hook for that, which is why now we're going to hear a lot of talk about why central bankers are going to pause at the next meeting, and potentially the Fed will pause in their December meeting as well. Regardless of the decision made at our next meeting, if the economy evolves as anticipated, which they have no clue what that is, in my view, we were likely near or at a holding point in the funds rate, and you bet you are, because if you go too much more, you could break the tipping point. And from my forecast, I would say we're within one of the peak, and then we can hold it there for a while. In September, a report on consumer prices, which showed they are still running at a brisk pace, is a reminder that the Fed cannot count on their progress continuing at the same good pace we have seen in recent months. And of course, we know they can, because I'm going to show you that. The Fed just doesn't understand what causes inflation. They're completely clueless. They think it has everything to do with the funds rate, and they're wrong. It's important to guard against becoming complacent if it takes longer and longer to achieve the Fed's 2% goal. And actually, that is an okay deal. If it did take an extra 6 months or 9 months beyond what the Fed's hope is, it would actually be fine, because what we know is we want to see a gradual return of inflation down. We don't need to see a rapid return, because generally that means demand is plummeting and unemployment is about to rise, and those are bad signs. Of course, we know the Fed keeps holding on to the labor market, and we keep saying at some point it's going to hit a wall. Metre added that the increase may be driven by higher growth expectations and acceptance that rates are likely to remain elevated for longer and investors demanding greater compensation. No, it has everything to do with the fact that Powell said, hey, you know what? If long rates go up, I'll stop hiking rates. And everybody thinks that that's bullish for the equity market. So what did they do? They jumped on the bandwagon. They gave Powell what they want. But the problem now, we got to look forward to what's going on with China, why the American dream is coming to an end. It perhaps is not everything just to do with China, but what's going on in the U.S. commercial banking system right now, because these backgammon rates are not working for the banks. Now, we know higher rates should be good. It means they should be lending at higher rates. The banks desperately need to do that. They need cash. They need deposits. And lo and behold, what are we seeing? Just the opposite here. When we look at the recent Fed 4.1 report, or H.4.1 report, what do we see this week? The Bank Term Funding Program. That means this is that lending program. The banks are going and borrowing money from the Fed. They're putting securities on deposit. That means these banks are taking more and more money from the Fed. Granted, it's not huge numbers, but the issue is all of this. It has to do with the fact that banks are taking money, because if the financial system was healing right now, and it is not, and this is a problem going into recession, the bank's usage of this program would go down. The issue here now comes back to the fact they just don't have enough deposits. They're not originating enough loans. It's all a big mess that's going to bring down a lot of small and mid-sized U.S. banks at the same time. And one thing we can note here, that when we look at the federal funds rate, we can see the Fed causing the problems in the banking system here. You look at the yield curve. This is the 10-year minus the 3-month Treasury yield curve. And what do we know? It is steeply inverted still, meaning the bond market is saying, Fed, you've gone too far. From a banking perspective, remember, they borrow at the short end of the curve and lend at the long end. So if short-term rates are higher than long-term rates, it's called you don't make money. And if you have a business, this is like selling your product at a loss for less than you paid for it. So what's the simple result? You just don't do it. In this case, banks are not lending, and that's why we're starting to see a problem here with money markets, because look at this, money market funds now crash the most since Lehman, but that's not the bigger problem. Bank deposits rose, but they didn't rise in the right place, and that is a bigger issue here. But something that also should be rising, that is your trading account. We're going to show you just how easy it is using our two reports. Many of you say, Steve, can it be this easy? And the answer is yes. Here, check this out from our October 11th report. This is our CTA-Timer Pro. This looks at the machine positioning. We talk about this every Sunday, so stay tuned for tomorrow's show. And what do you see here? The GDX. This is gold miners. A lot of you love to trade this. They were at max short positions on a historical basis. We said wait until you see them short covering. Now, our most successful traders using our reports, also pair this with our Momentum Timer Pro report. This looks all of those technical signals, smooths them all out for you. And look, we said when you see the machines short covering and you see a 1 on the daily buy count of Momentum Timer Pro, that is the signal you're waiting for. And lo and behold, if you would have bought at open on October 10th, using those same 2 reports, just as we showed you, you would have bought right here, and right now you'd be up 4.5%. That trade alone could pay for your annual subscription. If you pay for all of the months of this, there's links in the description below. CTA, $30 a month. Momentum Timer Pro is $20 a month, and you can lock that in for life. And there's still a few coupon codes left for that first month free. Check it out, because once they're gone, they are gone. But now, one thing that also is leaving, despite that headline, is commercial bank deposits, and that's not a good thing at all. And total bank deposits on a seasonally adjusted basis, here's this, dropped for the second week in a row by minus $8.7 billion. Of course, we know banks are desperate for deposits. And of course, one way to create them is to originate new loans. We're going to get into what's going on with that in a moment, because this is worst case scenario for the banks. And then you tack on what China just did, and you're saying, wait a minute here, it's potential. What we know as the American way of life is going to quickly come to an end during the next financial crisis. They have at least $109 billion hole in their balance sheet. This referring to those small and mid-sized banks that have a lot of that bank term lending program that they borrow from the Fed that needs to be filled by Marches. Now, you may not remember this, but back in March of this year, of course, that was a banking crisis. What happened is these banks went to the Fed and got a 1-year loan. They swapped their securities out, they got some cash, and now guess what? They have to pay that loan back at prevailing rates. They borrowed it at, can you believe it, at prevailing rates. The Fed did not give them a good deal on these loans. And so now they have to pay back the whole thing. So you can almost say, if nothing else happens, by March, the banking crisis is going to get a big problem for the Fed, and that means rates are going to have to come down. And here's the other problem the banks are facing. This is the worst case scenario for the commercial banking system, is the lending space. And here we can say, look at this, commercial industrial loans. This is the weekly data. Now, minus 0.1% year over year. It is outright collapsing. And what I want you to see is every downward move in the commercial bank lending on a year-over-year rate change. You'll notice there's a gray bar. That is a recession. Friends, we are on the edge, if not already in a recession. I know many of your comments have said, hey, you know what? I don't know what everyone else sees, but where I live, we're definitely seeing a recession here. This is the issue, because commercial banks create money when they create a new loan. And when money is paid back, that money is destroyed. So now we're going to start to see money being destroyed at a time when banks need deposits. They don't have enough. They're already borrowed out from the Fed. They got to pay those back in March, and you can only see how this is all going to come grinding to a halt and lead to a ton of bank failures. And sure enough, we know it's not going to get any better, because when we look at the 10-year, 2-year yield curve against commercial industrial lending, that's shown in blue. What do we see? The yield curve is still inverted. Banks still can't make money lending on the 2-year, borrowing against the 2-year, lending at the 10-year rate. They can't do it. How about the 10-year, 3-month? That now showing the inversion below the horizontal green line, still inverted. Again, banks can't make money lending. That's why we continue to see lending standards tighten. That's the problem with the debt-based economy, is you need a constant supply of new money to not only pay on the existing debt, but to fuel whatever level of growth you want. And so this is an issue. This should not be happening, and it's only going to accelerate to the downside, because here's something I'm going to leave you with. I'm not going to get into too detail here, but think about this. When you pay back a loan, the principal is removed from the financial system. It is destroyed. The interest stays. So ask yourself this. If you borrow money at 0%, how much of that money stays in the financial system? If you said 0, you got it right. And that's a big problem. So we're going to see money disappear out of the system at a time when the banks need it, and when the banks are not originating enough new loans to back those deposits, those that they do have, that means they have to buy bonds. And if you've been wondering why are banker CEOs like Jamie Dimon of JP Morgan Chase telling you short the bond market, rates are going higher, because he's going to have to buy a lot of them, and he would love to buy them at higher rates. He already knows that's coming, because, of course, lending is about to go into a massive contraction, and we can see that just from this headline alone. As big banks are quietly cutting thousands of employees and more layoffs are coming, they already know demand is going down. And pressured by the impact of higher interest rates on the mortgage business, Wall Street deal making and funding costs, the next 5 largest U.S. banks have cut a combined 20,000 positions so far. This move comes after a 2-year hiring boom during the COVID pandemic, fueled by a surge in Wall Street activity. Of course, we know the only way this business is coming back is if rates go down. That means not just to zero. Now, somehow the Fed is going to have to do the impossible and get rates below zero. You can only see massive amounts of QE. The Fed's going to have to buy up literally a global supply of treasuries. It's only inevitable when the next financial crisis hits of what is going to happen. And they need to find levers to keep earnings from falling further and further and to free up money for provisions as more loans go bad, which we've been saying will happen. And by the time we roll into January, you'll hear a lot of companies talking about this, because what happens when banks destroy money? That means there's not enough money to pay on the debt and fuel growth, and that means somebody's got to be a loser. You're going to see loans go into delinquency and then default. The banks are going to have to put a ton of money into loan loss reserves. They're going to be buying mountains of bonds. You can see this because this happens every cycle when the Fed inverts the yield curves and money curves. We know this for a fact. But while the banks are saying, hey, there's problems coming, U.S. investors are piling into equities, and global investors are moving into U.S. equities. But look at this. When commercial industrial lending collapses, we now show corporate profits after tax on a year-on-year rate of basis. And what does that tell us? When money is being destroyed, usually corporate profits are heading down. You wonder then, wait a minute, Steve, I see them spiking during the recession. Do you want to know why? It's because that's when the layoffs hit. It's all according to what we know is already going to happen. At some point, layoffs surge. So we have now the worst case scenario for the global banking system. And now you're about to see China has done the unthinkable. This is going to be a big impact on the U.S. way of life. As China's property woes pour cold water over steps to boost stocks. Again, this is all about the banks and creating money. If you look at this, commercial industrial loans here against the Wilshire 5000 price index, both showing a year-over-year rate change. Equity prices, everyone thinks they're going higher. But if you destroy money, and that's what happens when bank lending slows down, or even worse, outright contracts, guess what? You don't have enough new money to support the stock market. That's why prices come down. But that isn't the big issue. The big issue now is everything due to the dollar. De-dollarization, question mark, as China completes the first digital yuan purchase for cross-border oil transaction. Now, why does this matter? Of course, many of you know, you've heard of the petrodollar. That means crude oil around the world is traded in dollars. If you want it, you got to buy it with dollars. You sell it with dollars. You want your own currency back, you go to the swap markets and get what you need. But it's all traded in dollars. And one of the biggest fears that facing the U.S. way of life is the moment crude oil is no longer traded in dollars, and now China has placed the first nail in that coffin. A Chinese-based financial news outlet, UK, first reported PetroChina International bought 1 million barrels of crude oil using digital yuan on Thursday. It was the exchange's first overseas oil settlement in digital yuan. However, the name of the seller was not disclosed. And of course, they've made several transactions in yuan earlier this year, but this is the first blow to the end of the dollar. The only question is, who else is behind all this? We'll check this story out here, because in August, Brazil's president called for the BRICS nations to create a common currency as the world searches fiercely for ways to circumvent the dollar-based financial system. Why is that? Well, it's everything to do. When the dollar goes higher, which it is, that means there's a dollar shortage. So we need to actually see more dollars created. That means the dollar needs to lose value over time. I know some of you say, wait a minute, I want the dollar to hold its value. Well, it was never designed to do that in our global monetary system. So right now, everyone's looking for a way out of the dollar. If that happens, well, just think, we need other people outside this country to buy our debt. It's how our system works. If they aren't buying it, that means internally we have to buy it. Puts an end to how our economy looks in the future. And now we look at this headline here. Bad news for commercial real estate as architects report a big drop in business. Of course, we know who is sitting on a mountain of commercial real estate loans right now. That is the small and mid-sized banks. Look at this. While more firms are reporting a decrease in billings, the report also shows a hesitance among clients to commit to new products. projects with a slump in newly signed contracts. This as a result, backlogs at architecture firms fell to 6.5 months on average in the third quarter, their lowest level since the fourth quarter of 2021. And that means eventually architecture firms laying off as well. You're going to see all of this coming to an end at some point, and it seems like we're not very far away at this time, because it just is a matter of when the money stops. And my friends, that based on what we're seeing in the commercial banking system, based on the fact that it is going into contraction, China's trying to circumvent the dollar, and we can see that in March of next year, these banks have to pay back these big loans. The time is not on our side. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.